for this working session. First of all, I'd like to thank Atomium and the AI4People team for hosting this event. And what we're going to talk to you today about is the global AI, good AI global framework in the context of the insurance sector. We're going to have a number of different talks. I'm going to give an overview of where we are with our report, and there's going to be a number of different talks from the various participants you can see with us here. Just briefly, I'm a professor of computational finance and investment analytics at the University of Southampton, and I'm also the director of the Centre for Digital Finance at the university. And as I said, I'm the chairman for this committee. And I should say that we've had a number of people in this committee, some of whom will be presenting today and some of whom won't. So the committee is consisted of Patrice Chazaran, Rui Ferreira, Tilman Hengevos. Both Rui and Tilman are from the Zurich Insurance Group, and I should say Patrice is the Director of Digital Europe. Paul Jorion, who's also speaking today, who is an Associate Professor of Ethics at the Université Catholique de Lille. Jan Vitos Lanzala, who's a Professor of Strategy at the Cass Business School and is the Founding Director of the Digital Leadership Research Centre there. Nir Vulkan, who's an Associate Professor of Business Ethics at the University of Oxford, and Zenia Ziovalu, who is working with NCSR Democratos in Athens. And we'll also be joined this morning by two presenters who haven't been involved in the committee, and they are Maria Manuel Leitao Marquez, who's a member of the European Parliament, and Alex Towers, who's the Director of Policy and Public Affairs at the BT Group. Right, so let me just sort of, I'm going to talk about where we are with the report initially, and then we're going to have 5 different talks, I believe. And the first thing I want to say is sort of where we are with our report. We do have a draft report, but it needs a little bit more work, and it will be ready for final submission around the end of February. So it has been a difficult year in getting to this point, but as I say, we do have a draft report, and what we're going to talk about today is some of the issues we've encountered with that. So in getting into this whole area, we've basically sort of found ourselves addressing 2 main areas, or 2 main concerns in relation to AI in the context of insurance. And the 2 areas are the fair treatment of consumers and systemic sustainability. A lot of the focus is going to be on the fair treatment of consumers. How do we make sure that algorithms ensure that consumers are treated fairly and get good products, good prices, etc. But also there's sort of emergent behavior from interactions of AI systems, even though they might not be directly interacting, that can cause systemic problems, as we've seen elsewhere in the financial sector. The algorithms, as we found, are affecting every part of the insurance business chain, from customer acquisition to risk pricing, to the assessment of claims, and even to the investment management. Now, of course, insurance is a financial service. And in that sense, there's a lot of overlap with banking and finance report. But there are issues that come up in that that are really best addressed in the other committee. And as you'd be aware, there's a banking and finance committee as well. So insurance companies manage assets, and they're heavily involved in pension savings and in delivery of pensions, and in various sort of social protection products like life insurance, employment insurance, personal injury insurance, mortgage protection, things like that. And as I said, some of these are heavily overlap with what we look at in the finance committee. I should say I'm also a member of that committee. And there are areas where there's a heavy overlap with finance, where again, it's not something we're going to address, but I just want to acknowledge that there's this heavy overlap, where insurers have been closely involved with financial products, in particular structured products, CDOs, CMOs, where there's been an actual insurance component, and where there's been things like credit default swaps, which are actually insurance contracts on the risk of a bank or a financial entity defaulting. But as I said, that's not really what we're going to focus on in our committee. We're going to focus more on the conventional insurance products, or what people will think of as a conventional insurance product. Insurance also, I should say, brushes up against some of the other 7 sectors that are explored in the 7. You'd be aware that there are 7 sectors that are being explored from an AI4People perspective in relation to the good AI global framework, and there is overlap with a lot of them. I mean, the most obvious ones are the electric vehicles. There's obviously an insurance issue there for who is insured, who is responsible for an autonomous vehicle. There's also in health, there's a huge industry in health insurance, and that raises all sorts of issues about data and privacy. And it also overlaps with legal services, because there is the whole area of responsibility and I mean, the legal and regulatory frameworks underpin all of these issues of choice and responsibility, and these are having to evolve given the state of technology and the evolution of technology. So there's a systemic link in relation to, or systemic risk, I should say, in relation to multiple insurers using the same model. So I mean, when we think of systemic problems, we tend to think of other aspects of finance, of people all trying to hedge the same interest at the same time and causing a market crash. We don't quite have that in other aspects of insurance. As I said, the insurance industry is involved in asset management, but in other aspects of insurance, we don't quite have that. But what we do have is the risk that insurers could be using the same model or the same software, the same business practices to estimate risk. And that could mean that there are errors that might be logical errors in these models that could be magnified and mispriced and in that sense compounded because everybody's doing the same thing. And what we really want in these situations are for these things to be dispersed and diversified. We want people, if they're going to make errors, to be making different errors. So there are these kind of issues that we need to be mindful of in our analysis. You'll also be aware that there's a fintech revolution going on, and that's been going on for a number of years. And insurance is part of the financial services industry, and insurtech is an emerging area as its own subfield within fintech. And this is sort of giving rise to things like bespoke products, bespoke insurance products, microinsurance, where we have the ability to insure individual events rather than insure a period of time or short time events. This is enabling what would have been sort of block products over periods of time to be sliced and diced and allocated to individual periods of time. So it really is opening up the whole area of insurance, and it's adding a lot of things to what can be insured that's different from what we've seen when we look at insurance historically. And another thing that opens up when we do that, when we look at the insurance at the micro level, is we end up getting a sort of a feedback where we have a lot of data about what people are doing, and we can actually nudge and encourage behavior that is something that I wouldn't have been a big part of what insurers were doing. So we might be nudging and encouraging people to, say, drive below the speed limit, because we have these black boxes that go in cars that record details and can give information to the driver when they're behaving, when they're driving too fast or driving erratically. That can also give information to the insurer who might want to apply a higher premium if somebody is displaying this kind of risky behavior. So we can nudge back to the person to drive more safely or to have a more healthy lifestyle. So there's actually a social good a potential for social good if we use the data sources that open up correctly. And one of the things that does open up, when you look at the whole area of AI, there's a gulf between what the experts know and what the industry can become highly informed about, and what the consumer will know. The consumer will know a lot less. And that gulf of knowledge can be an issue. We need to try and think of how we can make the consumer better informed. They need to be more financially literate, and we need to think of ways of including insurance in that, so that they actually make good choices for themselves. So we need to develop we need to develop the educational aspect alongside the technological aspect. So from a business perspective, AI can lead to operational efficiencies. It can reduce costs. It can lead to better business practices, but it can also lead to positive social and economic outcomes if managed and steered correctly. So it can help us reduce discrimination. It can help us increase inclusion, and those are obviously good for overall society. And when we think of the risks of AI, we have four main risks. The risks are that there's a lack of technical skill among regulators and other key decision makers in the insurance sector. So we might well be able to hire programmers to write these great algorithms, but do the regulators have the skill to be able to monitor and test and measure whether customers are being treated fairly, or whether there's risks to the system? So there is this question of regulator education. Are they well enough educated in these technologies? And what there's then the question of how can we ensure that we have regulators who are well educated in these technologies? And I would say so it's not just the regulators; it's also the senior management within companies. Are they fully aware of the risks that are being taken on by the business? Second area of risk is the lack of awareness of engineers that are building the AI systems of the ethical and the wider implications of the system, so the wider social implications. If an engineer is told to build something that is aiming to maximize profit, they might not be mindful of the other potentially adverse consequences of that a system might facilitate a consumer in purchasing something that was actually against their own well-being. So there are issues there of making sure that the engineers think ethically when they're building these things and consider the adverse consequences, and consider also the computer interaction with humans, that people, when they interact with these systems, there might be a vision of how an engineer would think a person would interact with a system, and then there's the reality of how they actually do. So if they behave in an idealized way, they might get the outcome that was intended, but people often take shortcuts. They often do things that are not what the engineer had in mind, but can be fairly consistent across a group of people. So we do need to look into how people actually interact with it, and we need to test these systems before they're put out put before the public. And that sort of leads on to a related point, which is in relation to complacency. We're quite used to these kind of systems now, and we can get very comfortable with what they do, and they're pervasive now. We have them in our homes, we have them in many workplaces, many businesses we encounter, but we need to consistently ask questions of them and be mindful of the adverse effects and the fact that we are becoming comfortable with them, and the fact that we are leaving decisions to these algorithms. And it also opens up a risk of data breach. Data breach is a risk that we've lived with obviously for quite a while, but the one thing that is changing now is the amount of data that is being acquired. Huge amounts of data have been acquired. When we use smartphones or computers, they can track all sorts of information from the way that we interact with our devices. And a lot of this information, a lot of information about us can be extracted from this, because we can be categorized with groups of people, and certain features can be shown about those groups of people. So just by simple interactions, we can be giving away a lot more information about ourselves than we realize. And even today, I think there's a lot of information being accumulated and stored that the data analysts haven't figured out what they can tell about us, but they might well be able to tell more about us in the future by using that data. So there's huge stockpiles of data being accumulated, and that is a risk going forward for hackers getting into the system. I want to say also what we're looking at here is guidelines, and we're sort of suggesting the kinds of regulations. But we must remember that insurance is already a heavily regulated field. And for the financial functions of insurance companies, the finance sector in general is very heavily regulated. We don't necessarily want to add to the burden of that, but there is a question about whether the existing regulations are able to cater for emerging technologies, and if they're not, what do we have to do to adapt them to make sure that they do cater for it? We've looked at a number of different things in our report, and I mean, we're suggesting that we could have some sort of a traffic light system where we can evaluate and categorize the various algorithms in terms of their safety, and you know, I think that's a potentially useful idea. But I also think that one thing that we possibly need to think about when we look to the future is, right now we're thinking very much about algorithm to consumer interactions, where we have this algorithm, we have an uninformed consumer who essentially could the interaction between the algorithm and the consumer could lead to a suboptimal or an adverse outcome for the consumer, and that's the way we're thinking about it. But I think even going further, we might well be looking at a situation where we have to think about the emergent behavior from algorithm to algorithm interactions, and I say that because this technology clearly works very well from the perspective of implementing the provider side of the relationship. But given that it works so well, it wouldn't surprise me if some future startup came up with a technology that represented the consumer side in this technology, and then we would have algorithms negotiating with algorithms, and we would have all sorts of unintended outcomes from that. And I think that's a whole set of headaches that we haven't even begun to think about. But on that note, I would like to hand over to some of the other speakers for today. And I believe the first one that we have scheduled is